Welcome to my series of videos on managerial economics, and in this particular video I'm going to solve a practical example on the issue of externalities. Now, a requirement to watching this video is that because the series on externalities is in two parts, please do well to watch the first part or the first video on externalities before you watch this one, so that it will enhance your understanding on this particular practical example. Now, this example says that suppose the external marginal cost, or in other words, the marginal external cost is 3 kil. The internal marginal cost, or the marginal private cost, that's the MPC, is 6 kil. And then the inverse demand function for steel is given by P is equal to 100 minus kil. Number one says that in the absence of externalities, what is the equilibrium quantity and price if the industry is perfect competitive? Number two also says that in the absence of externalities, what is the equilibrium quantity and price if the industry is a monopoly? Now, before we move on, let's try and deal with the answers of these first two. Now, remember, in question 1 and in question 2, they all have the preceding phrase that in the absence of externalities. Now, once we say in the absence of externalities, what that means is that we are going to solve them like the normal equilibrium of a perfect competitor and a monopoly. So once there is no externalities, their marginal cost is actually their marginal private cost. When it comes to a perfect competitor, their equilibrium point occurs at where price is equal to marginal cost. However, here, since we are not internalizing the externalities, their marginal cost actually is their marginal private cost. So we equate the price function or the inverse demand function, that is 100 minus kil, to the marginal private cost, which is 6 kil. So if you solve for quantity, you are going to get quantity to be equal to 14.29. And then if you also solve for the equilibrium price, you are going to get 85.71. 85.71. Again, if you want to, or if you wish to solve same for the monopolies, which is the second part of the question, monopolies, their equilibrium point occurs at where marginal revenue is equal to marginal cost. But as I mentioned earlier, when they are not internalizing the externality, their marginal cost is their marginal private cost. So then again, we obtain marginal revenue from the price function. So when you work marginal revenue from the price function, you are going to get 100 minus 2 kil. And when you equate that to the marginal private cost and you solve for quantity, you are going to get quantity, the equilibrium quantity to be 12.5 and the equilibrium price to be 87.5. Now, the third part of the question says that what is the socially efficient level of output and price if the industry is perfect competitive? Now, whenever we want to look at the social efficient level of output, what we mean is that technically, the firm would have to internalize the externality. Otherwise, whatever they produce to the society is not efficient, it's not helping the society. So when we say what is the socially efficient level of output and price of a perfect competitor, what it means is that the perfect competitor would have to internalize the externality. So in which case, if you remember, I mentioned that when a firm internalizes an externality, in our previous video, I mentioned it, that when a firm internalizes an externality, and the externality is negative, their marginal cost is no longer private, but it becomes marginal social cost. So in essence, if you internalize an externality, it's going to increase your cost of production. That is why the marginal social cost here, we obtain it by simply adding the marginal external cost to the marginal private cost, okay? Because if you internalize an externality, it's going to increase your cost of production. So in essence, the marginal social cost becomes the marginal private cost, which is 6 kil, plus the marginal external cost, which is 3 kil. So you add it, the marginal social cost becomes a total of 9 kil. Now remember, we will make some modification to the equilibrium point of a perfect competitor, because in this context, the question says that what if they internalize the externality? So we work again. Now, instead of price is equal to marginal private cost, it becomes price is equal to marginal social cost. So then we have price function, which is 100 minus kil is equal to the marginal social cost, which is 9 kil, which was actually obtained by adding the private cost and external cost. So at equilibrium, we have 10 minus kil is equal to 9 kil. If you solve for quantity or kil, you are going to get 10 units, and then the equilibrium price is equal to 90 cedis. The equilibrium price is equal to 90 cedis. Now, in some jurisdictions, governments do not impose legislations for firms to internalize the externality. So what government does is that instead of asking firms to internalize the externality, what they do is that they rather charge taxes, and then they use the tax revenue to clean up the mess created in the environment by the negative externality. So another option to firms who have been asked to internalize an externality is that instead of internalizing the negative externality, they can rather pay tax and still create the externality, and then the government will use the tax revenue to clean up the negative externality created in the environment. Now, if that is the case, it means that they should not be better off or worse off when we compare to their marginal external cost. Because the only difference between the marginal social cost and the marginal private cost is the marginal external cost. So if they are not incurring that cost in terms of their production, what it means is that they have to pay tax, which is equivalent or the same as the marginal external cost. So the government will rather use that money to clean up the mess in the environment. Now, the tax per unit that the government will have to charge will be 3 kil. Why is it 3 kil? 3 kil because I said that instead of maybe incurring the marginal external cost of 3 kil, right? What they could also do is that they rather pay it as tax, and the government will use the revenue to clean up the mess, right? So 3 kil, it means that we are multiplying 3 by 10. And the reason why we are multiplying 3 by 10 and not by the initial 14.29 is that you must pay tax, which is just equivalent to your marginal external cost, should you have internalized it. So that's why we use the 10 kil over here. So 3 times kil, which is the tax per unit, will be 3 times 10, and that will be 30 cedis per unit. Per every unit that you produce, you're going to pay tax of 30 cedis. That means that once they are producing 10 units, the total revenue that will be, gotten from taxes by the government will be the 30 cedis per unit times the 10 units. The total revenue will be 300 cedis. 300 cedis. And then the last question here says that, what is the socially efficient level of output and price if the industry is monopolistic? Of course, if the industry is monopolistic, instead of saying MR is equal to MPC, it will be MR is equal to MSC. So in which case, we are going to have 100 minus 2 kilo, which is the MR function, is equal to MS, which is 9 kilo. So if you solve for the values of quantity, you are going to get 9.1 units. And then the equilibrium price is 90.9 cedis. Let's take the very last example for clarification. So this example says that suppose a company operates in the oil and gas sector. It is the only company in the sector. Now, when we say a firm is the only company in the sector, what it means is that it is monopoly. Okay, it is the only company in the sector, which means it is monopoly. And it faces the following cost and inverse demand functions. So in this question, the total external cost is 10 plus 3.5 kilo squared. Total private cost is 80 plus 4 kilo squared, and the inverse demand function is 100 minus 2.5 kilo. The requirement is that we should find the social efficient level of output that should be produced by the company. Now, here also, right, when we say social efficient level of output by the company is monopoly, which means that their social efficient level of output means they are going to internalize the externality. So in which case, the output can be gotten by MR is equal to MSC. So the output can be gotten by MR is equal to MSC. However, we have to go through a number of steps to derive the MSC. Now, to do the marginal social cost, we need to add marginal external cost to marginal private cost. Now, the question gave total external cost and total private cost. So if we want the marginals, we just differentiate with respect to quantity. So if this is our total external cost and you differentiate with respect to quantity, you are going to have 7 kilo as the marginal external cost. And if this is our total private cost and you differentiate with respect to quantity, you are going to have marginal private cost, okay, which is 8 kilo. So if you add the marginal external cost to the marginal private cost, which will be your, we are going to get a marginal social cost. So 7 kilo plus 8 kilo is 15, which is our marginal social cost, okay? And if you want to find our marginal revenue, we all know how to derive marginal revenue from the price function. You can convert the total revenue and differentiate, or you can just double the slope of the price function and it will jump you to marginal revenue. So now we have marginal revenue to be 100 minus 5 kilo, and then the marginal social cost is 15 kilo. So if you work it through, you get the quantity to be equal to 5 units. So the quantity is 5 units. The second part of the question says that based on your answer above, instead of defining property rights, what amount of tax per unit should be imposed by the government for the firm to produce a social efficient level of output? Then how much will government generate in total from the taxes? So here again, the tax per unit, as I already mentioned to you, it must be equivalent to the marginal external cost. So the tax per unit is equivalent to the marginal external cost, which is the 7 kilo, and then the quantity is 5 units. So when you put the 5 units in the function, 3 times, so it's supposed to be 7 times 5. So 7 times 5. Okay, because the marginal external cost is 7 kilo. So 7 times 5, we are going to get 35 cedis per unit. 35 cedis per unit. And once they are producing 5 units and the tax is 35 cedis per unit, the government is going to generate a total tax revenue of 35 times 5, and that is 175 cedis. So instead of government asking them to internalize the externality, they could rather ask them to pay a total tax revenue of 175 cedis, and that 175 cedis would be used to clean up the mess created by the externality. I believe I've been able to explain to you the concept of externality. You can use similar idea and solve questions when it's a benefit. When it's a benefit, it rather become marginal social benefit is equal to marginal cost. And our marginal social benefit, if it's a perfect competitor, it will be price plus the marginal external benefit. If it is a monopolist, it's going to be marginal revenue or marginal private revenue plus our marginal external benefit. Okay, so there are examples like that. You can search on the internet and find examples like that and solve. Thank you very much for listening to the explanation on externalities. I would like you to share, comment, like, and subscribe to my channel for more content. Let's also have some feedback at the comment section. So in the next series, I'm going to talk about public good. Public good. All right, so stay tuned and meet you soon. Thank you.